Okay, this video just continues with 10.24 at adjustment number 8. Okay, so we're at 10.24, adjustment number 8. It says, physical stock taking figures on the last day of the year are as follows. Trading stock and consumable stores. My advice is deal with them differently. Each of them has their own two accounts that they affect. With trading stock, the rule is you have to compare the value that we have counted to the book value. Okay? In other words, we have to compare the value that we counted to the value we think we have in our books. Let's deal with this first. Okay. The book value on the pre-adjustment trial balance is 21,450. But do not forget that we just subtracted 6,700 Rand from trading inventory because of theft. Okay, remember we just did it in adjustment number 7. So the new book value that we have for trading inventory is not this anymore, not 21,450. It is 21,450 minus the stolen stock. In other words, 21,450 minus 6,700 is 14,750. That is the value that you have to compare to the value that was counted. Okay, remember that. Take anything above that would affect stock into account before you compare the two values. Okay, you can see that the value that we have counted is still less than the value that we thought we should have. In other words, we've got a trading stock deficit. To determine the value of the deficit, you say the book value, which we have established is 14,750 after the theft, minus the value that was counted, gives us 1,250 Rand of stock that went missing. The two accounts that are affected is trading stock, which is an asset. We have to decrease it because we lost stock, and trading stock deficit, which is an expense that we have to increase. Okay, our expense gets bigger, our losses get more, our profit gets smaller. 1,250 credit and a debit. Then let's deal with the consumable stores that we have counted. Remember, this works a bit differently. The total value that we have counted is the value that is on hand at the end of the year. And we want to convert this into an asset. At the moment, the 320 Rand is lying in consumable stores as part of this 4,550. Okay, but not this whole value has been an expense for this year because 320 Rand wasn't used and we will use it next year. So it will be an expense for next year. And the rule is anything that we have in our business that applies to the next financial year must be taken out. So we have two accounts. We've got the expense account called consumable stores. And we've got the asset account called consumable stores on hand. Please don't get confused. On hand is the asset. It's what we have for next year. All we do is the value that we have counted gets moved from the expense account. You minus it and you move it into the asset account. So you just change its identity from an expense to an asset. It's an asset for us because it puts us in a better position. When the next year starts, we have it there, we can immediately start using it. Then adjustment number 9. Okay, now this adjustment looks like an English essay. It says interest is added to the loan. It's capitalized. Okay, interest on loan, immediately you need to remember it's an expense. Loan is a liability, we pay interest on it. So interest on loan is an expense. And it is capitalized. In other words, added to the loan. At the beginning of the accounting period, the loan balance was 120,000 Rand. Loan repayments were made and recorded during the year. The total interest on loan for the financial year is 16,400 as per the loan statement. The adjustment entry must be made. Okay, so the only thing, well, two things that are important in this whole paragraph is the fact that it is capitalized and they gave you the value of interest. Okay, all the rest is just extra information that you don't need. You don't need to know when we took out the loan. You don't need to know that loan repayments were made. You need to focus on the interest value and you need to focus on capitalized or not capitalized. Okay, if you go and look on your pre-adjustment trial balance, you will see that we don't have an interest on loan account at all. This means that none of this has been recorded so far. So the full value needs to be recorded as an expense. So what you do is you create this account. Remember, if you need an account that is not there, you just create it in the correct section. Please, income and expenses, nominal section. The full 16,400 Rand must be recorded. If the statement says that's the interest that we need to pay, then we need to pay it. Okay. The contra account will be credited, whatever the contra account is, because every debit needs a credit. The contra account depends on whether the interest is capitalized or not capitalized. In this case, it is capitalized, so it is added to the loan. The loan is a liability, and our liability just gets bigger. They added interest to it, so now we have to pay the normal loan plus the interest. If it was not capitalized, let me show you. The only thing that would have changed would have been the name of this account. Okay, so not capitalized, it would have been like any other expense that we haven't paid yet for the year. Okay, because not capitalized means we actually physically have to pay it. And that would have been called accrued expense, which is also a liability. Okay, so if it's not capitalized, it's accrued something. Interest on loan, accrued expense. Interest on fixed deposit, accrued income. If it is capitalized, you add it straight to either the loan, if we're dealing with the loan, or if it was interest on fixed deposit, you would have added it straight to the fixed deposit. Only difference is the name of the contra account. The next adjustment says a further 2,700 Rand is still due on the interest on fixed deposit, according to the statement. Okay, so interest on fixed deposit, we don't have the full value yet. We have to increase it with another 2,700 Rand. Then they have a little note here. They say interest earned on the fixed deposit is received twice a year and it is not reinvested. We don't stress too much about the twice a year. They already gave us the value, so we don't have to calculate anything. We have to care about not reinvested. Reinvested is a synonym for capitalized. So interest is not capitalized in this case. They gave us the value that we still need to add, not capitalized. Okay, let's go. In this case, the two accounts are interest on fixed deposit, which is an income. You need to know this. Fixed deposit is an asset. Here we earn the interest. It's an income. We need to add 2,700 Rand to it. That's what the transaction said. Okay, so this is our credit. Whatever the contra account is must be the debit. And because it is not capitalized, the contra account is accrued something. What are we working with? Income. So it's accrued income, which is an asset. Okay. If it was capitalized, then as I showed you with the loan just now, the only change is the name of this account. We would have added it straight to the fixed deposit. Both of them are assets, both of them are debited. It's just the name of the account. Okay. I hope you are realizing that interest is not that. Number 11 is the easy one. Commission income was received in advance. They told you what happened. We received commission income that is for the next financial year. So what do we want to do? We want to take it out of commission income. We want to make the value smaller. Okay. It is not for this year, it's for next year, so it will be deferred. The two accounts are there for commission income, which is an income plus minus, and deferred income, which is not an income account, by the way. It's a liability. Why? Because we received some money that we haven't earned yet. Okay, so we are liable to actually do something, to sell things, to earn that commission next year. We want to make commission income smaller because it's not for this year. We want to take it out. This is our debit. Our credit is then deferred income. That makes sense because our liability. Number 12 says a business check was used to pay the cell phone account of the owner's wife, and it was entered as cell phone charges. This is an error because if it's anything for the owner that we are paying with the business money, it is called drawings. Our accountant just added it to the wrong account. Okay, so if you look at your pre-adjustment trial balance, at the moment, it's lying in cell phone charges. We just want to take it out and put it into drawings. Can you see there's no drawings here? So you will have to go and add drawings on your post-adjustment trial balance. In the balance sheets section, please, drawings is not an expense. Drawings in capital always go to balance sheet. Okay. So correction of errors, super easy. You just take it out of the account where you don't want it, which in this case is cell phone charges. The accountant accidentally recorded it here. You don't want the 650 Rand in cell phone charges, so you minus. And where do you take it to? To drawings, which is an owner's equity account. It's the D of dead. So we debit it. We make drawings more. Any correction of error, take it out where you don't want it, put it in where you want it. Credit, debit. And then lastly, standard, we've got depreciation. Okay, on vehicles at cost, if you get that, then it's easy. You go and look what was the cost price of the vehicles, 124,000, and you just multiply that with the percentage. Okay, so the calculation would have been 124,000 multiplied by 20%, okay, which gives you 24,800. Just that, 124,000 multiplied by 20%. The two accounts are depreciation and accumulated depreciation. We debit depreciation, which is an expense. Remember, you will always have to add it to the bottom of the nominal section. And we credit accumulated depreciation, which is a negative asset. So it just gets more and more. And then last but not least, depreciation on equipment at 15% on the diminishing balance method. Okay, so if it's this method, then you have to remember you need to work with the carrying value. So you have to take the cost of equipment, the 60,000, and you have to subtract the accumulated depreciation of equipment, the 31,000, before you can multiply it with the percentage. Remember, the name of the method is long, so the calculation is a bit longer. That's a very silly way to remember it, but it works. And that gives you depreciation of 4,350. Okay. The two accounts are similar to that of vehicles. It's depreciation and accumulated depreciation on equipment. We debit depreciation and we credit accumulated on equipment. Please go and look at depreciation when we bought a new asset during the year. We haven't had that in a while. Make sure you can still remember how to do it. Okay, this is it. Thank you so much for bearing with me, and I've got a lot of confidence that you will do well. Bye.